Good afternoon, everyone. My name is John Swolst. I'm the Director of Conference Content here at IndexUniverse. We are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's largest ETF conference. Joining me today is Mark Carver. He is an investment strategist in BlackRock's Multi-Asset Strategies Group, responsible for iShares Factors products. Before we go ahead and get started with the webinar, I would like everyone to know that I will ask Mark a few questions along the way. You can ask questions at any time during the webinar in the window at the lower right of your screen. Also, the slides in the presentation will be available to you within 24 to 48 hours after the webinar. Today we're gathered to discuss factor-focused investing as it's clearly gaining popularity. It helps that Eugene Fama, one of the scholars that helped bring into focus factors, just won the Nobel Prize in Economics last month for his work on defining the difficulties for predicting near-term movements in asset prices. His work helped to open the door to the idea that capturing broad market movements through indexing was a lot more sensible than pursuing single security selection. More to the point, today's webinar, Pharma and the host of other researchers, including partner Kenneth French, helped to define the very concept of beta, as well as investment factors, notably size and value, that could be isolated through indexing methodologies. It's no exaggeration to say that they have colonized pockets of the investment markets that were once dominated by active managers. Alpha has been turned into beta, thus opening the door to countless investors to access these corners using relatively cheap index products. And the process continues as such new factors as momentum and profitability and quality almost become isolated. It's no wonder Warren Buffett is on the record saying most investors would be best served embracing index funds. After all, he made profitability one of the most important considerations in choosing stocks. And now profitability can be isolated as well through an indexed approach. My guest, Mark Carver, helps design factor-focused funds at iShares, the world's biggest ETF company. Mark won't be talking at length about particular ETFs, but I'd be remiss if I didn't mention a few iShares funds that have come to market and moreover have gotten traction. The iShares MSCI USA Value Factor, VLUE, has over $116 million in it. There's the iShares MSCI USA Quality Factor, QUAL, with over $173 million in it, as well as the iShares MSCI USA Size Factor, which is ticker symbol SIZ, and that has over $117 million allocated to that fund as well. With that background and focus, let's turn it over to Mark Carver of BlackRock. Mark?
Great. Thank you, John. Good afternoon to everyone, or good morning, depending on where you find yourself today. Appreciate the opportunity to talk here today about a topic, I think, John, you outlined it well, is gaining tremendous favor by investors today. Just by way of putting that into perspective, what we've seen in ETF flows this year is roughly $56 billion globally go into non-cap weighted strategies. And in the simplest form, when we're thinking about factors, really what we mean are systematic moves away from the market cap weighted portfolio. And you've got to believe that by moving away from the traditional index construct of a market cap portfolio, you can be rewarded by doing that. Clearly investors believe that. They're starting to do that. The winners this year in terms of flows have been dividend strategies, minimum volatility strategies, low vol strategies. Some of those, particularly min vol, people might think of as a factor. Dividends aren't always thought of as a factor, but from where I sit and the work I do, we clearly think about dividends as a factor exposure. What I'd like to do today is really focus on the content of factors, making the case for factors. There's material in your slides that references iShares products. I intend to spend less time on iShares products and more time on the case for factors. I'd like to cover three topics with you today. The first is just defining factors. I think it's important that we all think about this topic from the same foundation. So we'll start at the simplest form. We'll talk about what factors are, what we mean when we use that expression. Next, I'd like to make the case for factor investing. John referenced Fama and French. I'd suggest to you that the concept of factors goes, precedes them by a fair bit of time, both from an academic and more importantly perhaps from an empirical or industry standpoint. So this is not a fama French. This is an academic construct that I think we'll bring to life a little bit today. And then finally, and probably interestingly for many of you, is what do you do with factors? I'd like to talk a little bit about client usage, pairing relationships, environments for factors, things like that. So we'll talk about factors, the case for factors, and then obviously client usage and implementation ideas. With that, let's begin. So when we think about factors, what we really mean are investment characteristics that help me understand the risk-return behavior of a stock or, frankly, any asset. What that implies is that I can decompose a security and understand its behavior based on certain relationships. And more importantly, I can capture stocks that have similar characteristics, and by capturing them, I can isolate stocks with those characteristics and ultimately profit from them. The first identified factor is the market factor measured by beta. Everybody in this on this call, everybody in our industry uses beta in some form, most typically through the capital asset pricing model. CAPM tells us something fairly straightforward. If I want to get a higher than average return, I take a higher than average risk. The fact of the matter is that isn't necessarily true. I can look at stocks within an industry that have a similar profile in terms of its product content. They may have a similar beta, and they may give me very different return patterns. The example I always like to use are Coke and Pepsi. Coke and Pepsi are stocks, more importantly, they're companies that compete in every product category across every store around the world. So you might argue, if you think about it from a product standpoint, those two companies are fungible, right? You could drink a Coke or a Pepsi if you want a soda. You could eat the same type of snacks from the two companies. So in some ways they're fungible. The two stocks have the same or virtually the same beta, depending on the time frame you use. It's virtually indistinguishable. So in some ways someone might say that the stocks are fungible through the CAPM lens. But the fact is the return patterns of those stocks is not the same, despite the fact that CAPM would predict that they would be virtually the same. And so what this tells me is that by moving beyond the single market factor and isolating other characteristics, I'm going to better understand the behavior of Coke and Pepsi, or frankly any stock. Those other characteristics include things like volatility, leverage, quality, value, momentum, size. What we've found is that academics and investors have identified these other factors, these other exposures, and we've been able to systematically capture those exposures and benefit from them. There's a lot of academic study that I'll partly bring to life as we go through, but really at the end of the day, what we're talking about with factors are investment characteristics that better help me understand the behavior of a stock. The classic examples that people point to, that the media is talking about today, are the ones you see on the slide: size, value, volatility, quality, and momentum. These are proven by academics. Better still, they're used by investors to try to generate a return that's different than the CAP index. Investors are attracted to these concepts for one of two reasons. One is, I want to get a return enhancement. The second is, I want to get risk reduction. The return enhancement comes in the idea that smaller stocks outperform over time larger stocks, for example, or momentum stocks outperform the cap-weighted index. So I'm capturing some type of return anomaly or return enhancement. The risk reduction in factors comes from two flavors. The first is a classic hedging, where factors themselves can have very interesting correlation benefits. Value and momentum, in the purest sense, have negative correlation. Quality and value have negative correlation. So when you pair them, you could actually potentially create a return anomaly, but by taking down your risk, because those two ideas don't behave the same. This is a very different paradigm Where most of us build portfolios based on asset classes, those asset classes can be very highly correlated. Factors might be able to introduce a different diversification benefit to an asset class portfolio.
Mark, if I could jump in for a second here just with a quick question for you. When you're discussing risk and return as you look at the different factors, is it easier to identify whether a factor would lead to an enhanced return or reduce risk? So is it easier to identify that this will be a risk reducer and this one will enhance my returns, or are they kind of on equal footing when you look at them and you want to use them within a portfolio?
Yeah, so it depends on the way you use them, right? So in isolation, you would think of value, size, etc. as classic return enhancements, momentum classic return enhancements. But if you're using them as part of a broader portfolio, they could change your risk profile because they'll behave differently. So it's a diversification risk hedging strategy. We talk to a lot of clients who have value biased portfolios, right? This really strong value tilt. So then the question is, if I want to hedge that risk to value, what do I introduce? Would it be a momentum idea, a quality idea? I'll talk a bit more about that. Some factors like low volatility, minimum volatility clearly suggest that you're doing that to reduce the risk you're taking in your equity portfolio, right? So that's fairly straightforward to think about or to understand.
Thank you.
Yep. So when we use these terms, size, value, let's just maybe talk about what we mean by that, sort of the case for those concepts. When we think about size, we're clearly talking about cap weights and the relative size of a security. The idea is that smaller companies have a higher return profile than larger companies. So to capture the size effect, what you're trying to do is push down your market cap to try to benefit from the return enhancement you get from smaller names. This is a particularly interesting strategy when you look at the large cap universe. What we find in our work is that if I take a large cap portfolio and I shrink the market cap, there's a lot of return enhancement I can do that. I can gather from doing that. For many of us on the line, the way we try to capture size is we buy mid-caps or small-cap stocks or mid-cap or small-cap ETFs to try to capture that size premium. You're doing something similar, but you can do it not just across asset classes, but in fact within asset classes, particularly within the large cap, and it's an interesting anomaly. Within value, what we're talking about are whether stocks are cheap or expensive. The idea is that stocks that are undervalued will subsequently outperform. Stocks that get overvalued subsequently underperform. There's this reversion to the mean. So those stocks that look cheap, they appreciate, and then you capture a return anomaly. Volatility is generally thought of as playing the low vol or low beta strategy. There's been a lot of work dating back as far as 1972, in fact, on the idea that low beta stocks, low vol portfolios actually give you a higher return than finance theory would predict they would or forecast that they would, but in some environments they give you a better return than high beta stocks. If you played the high volatility, over time that's actually a negative return strategy. You would earn a negative excess return relative to a cap index. So typically volatility is about low or min-vol anti-beta. Quality is one of the most interesting factors because there's less agreement on what that means. When you talk to active managers, they'll often define quality as companies with unique competitive advantages. Maybe it's brand strength, product strength, pricing power, good management, things like that. From a quantitative standpoint, we're thinking about things that we can measure. So we think about profitability, earnings variability, leverage. So we're really focused more on the earnings quality of a company, which I distinguish from the competitive advantage of a company that's qualitatively thought of and often is the way people think about it from the media standpoint, for instance. And then momentum is about trends, positive price trends. Momentum is a curious factor because finance theory says momentum shouldn't work, right? The price of a stock should be about the fundamentals of the company. but momentum effectively says that today's winners will be tomorrow's winners. And there's been a lot of academic studies on this. In fact, probably close to 300 academic studies on momentum trying to explain this phenomenon. But the fact is, what you find is that when you buy winners, they tend to continue to be winners. I'd liken it to a basketball coach who tells his team to keep the ball in the shooter with the hot hand. That's a simple analogy to think about momentum. It's a more of in some ways, a behavioral factor. So that's the general sort of description of these ideas. The fact is, when I try to capture these factors, there are a range of measures that I can use to capture them. We've listed some here on the page, but the reality is I can use a lot of measurements to try to capture the same concept of momentum or quality, of value, of size, etc. Earlier I mentioned one of the interesting things is the correlation benefit that you can derive from factors. Different from what you might derive in an asset class portfolio, this helps reduce the risk we're taking. What you see here is the correlation of active returns. The reason we show the correlation of active returns goes back to what I said at the beginning, is we're taking a bet away from the cap-weighted index. So the return I'm interested in is the return I can derive that's different from if I'm just buying the S&P 500 or the MSCI USA or the Russell 1000 or the Russell 2000 index. I'm interested in that excess return or active return I can derive, because what I'm looking for is to capture that excess return anomaly and improve my profile relative to the cap index. What it clearly shows you is there are some interesting relationships across factors. When you look at value and momentum, value and quality, clearly they stand out. The active returns are strongly negatively correlated, so when I pair them, they might have interesting pairing relationships. It helps me change the return and risk profile of my overall portfolio.
And Mark, we actually have a question regarding quality from the audience. Someone wants to know, isn't quality just a moat rating? Is this thing more subjective and more dependent on an analyst than it would be any individual number per se, and it's just really kind of looked at on a subjective basis?
So I'd say no. It's a bit different. So the classic moat, and I think we'd all agree on the line that having an economic moat is a good thing, right? You want to have a competitive advantage, but the fact is quality can be different than that. In fact, depending on the measures you use to capture quality, you see a different return pattern. A lot of people think quality is about profitability. I would argue that profitability is a great thing. It's part of quality, but it's also about the sustainability and the variability of that profitability. So it's a little different than a moat. The fact is there are classic value stocks that quite likely have some economic moat. When I think about a moat, I'm thinking about that generally not in the cross-section of the whole universe, but often within the particular sector itself, right? So it can be a bit different.
Well, thank you. Appreciate it.
Yeah, but it's actually a good segue to what you see here is the suite of iShares products. We have 10 factor products here. I'm going to talk a little bit about them, mostly about their methodology, just to try to bring this to life, keeping on with the question John just asked. But what you'll see is we have 8 of these products that are based on indexes, all using MSCI indexes. 4 of them are minimum volatility products. 4 of them are U.S.-based individual factor exposures to quality, value, size, and momentum. What this tells me is that I can do this in a systematic indexed-based construct. And the beauty of that is, for a long time, factor strategies were not investable for most of us. What we're seeing today is the democratization of factors. We no longer have to be a large institutional manager running a long-short portfolio. We can be an advisor running a high net worth practice who can bring these exposures in a very democratic very cost-effective, investable way through an index methodology. On the far right, you see two products. There'll be two more launched in an enhanced brand. What those are is they're multi-factor strategies that combine quality, value, size, and minimum volatility. For some of you, rather than thinking about tactical rotation across factors, you may say, I'd rather have a blended approach more as a strategic holding. The enhanced products are designed for that purpose, to give you a strategic allocation to a multi-factor strategy. So if we skip ahead, you'll see the slide in front of you, slide number 11. This is the way these ideas are captured in a systematic index form. Now remember, earlier I mentioned there's a lot of ways I can capture a factor. There's different ways we capture factors depending on the strategies we're managing for institutions internally, even within BlackRock. So I'm going to describe these for you because this is one way, and it's proven to be a very effective systematic way to capture factors. Let's start with the universe. For all of these ideas, the universe is the same. It's the MSCI USA Index, which is a standard index for MSCI representing large and mid-cap stocks. So that's the constraint here, is it's a universe of just U.S. large and mid stocks. That's 600 names across that index. The difference of these four products will be whether or not they reweight the entire index or if they own a subset of the index. So the two strategies on the outer edges, the quality strategy and the momentum strategy, own a subset of the index, which I think intuitively as we go through it'll make sense. You'd want to own stocks with the highest rankings to quality or the highest rankings to momentum. The two ideas in the middle reweight every security in the MSCI USA. So you reweight it based on value or risk instead of the cap-weighted index. So let's start in the purple box, the MSCI USA Quality Index. What this methodology is designed to do is rank securities based on three measures: profitability, as measured by return on equity, leverage, and then earnings variability, or in other words, the sustainability of earnings. Stocks are ranked using a Z-score, right? It's a statistical ranking based on standard deviations, but it allows me to quickly rank one stock versus another, right? Or in this case, it allows MSCI to do that. And at the end of the day, what you get is a portfolio of highly profitable companies, high ROE with low leverage and low earnings variability. The subset of the universe is 125 names from that 600 names. There aren't sector constraints put on that. Sometimes quality strategies or any factor strategy might have some sector constraints. In this case, there aren't sector constraints put on it. But you get a portfolio that's made up of names that I think most of us would agree feel like high quality names. The performance long-term of quality is highly attractive. Over the years when we've looked at the historical performance, including the pre-inception performance of this index, you see that this strategy would outperform a cap index. Historically, it's been 2/3 of the time. But over time, it's generated about 170 basis points of excess return annually to a cap index. So that's a very attractive sort of risk-return profile for quality. For the blue box, the value-weighted, this is a fundamental index. Some of you are familiar with the concept of fundamental indexing. Rather than weighting stocks by market cap, the argument of a fundamental index is that the better way to measure the economic size of a company is based on things like accounting variables. So in this case, every stock is reweighted based on its cash earnings, total earnings, book value, and sales. With the exception of book value, it's looking at a 3-year average. Book value is as of the last fiscal year end. But the idea is that the accounting variables would better tell me the economic size of that company and the economic value of that company by reweighting that and by doing 600 names in this weight, you get a portfolio that has characteristics of a value portfolio based on its price to book, price to earnings. I would contrast this to a traditional value index such as the Russell 1000, S&P 500 value, Russell 1 value. In those methodologies, what happens is you take a group of stocks that are defined as value, and then you weight them based on their market cap. Here, you're weighting the stocks based on their exposure to these specific factors. And by doing so...
Oh, go ahead, Mario. I was just want to interrupt you there. We're going through these four different factors, and there's quite a bit of information here. Knowing that ETFs are designed to bring transparency to the table and help investors see what they're investing in, is the methodology for all four of these funds available somewhere, whether through the iShares website or through MSCI? And how can people kind of take a deeper dive into these methodologies to understand the products better?
It's a good question. So they're all available on the MSCI website. So the content's easily searchable if you go into to the MSCI site. In the search field, just put in MSCI risk premia or MSCI USA quality methodology, and you'll see the methodology documents all described.
Thank you. We were just getting a few questions from people, so just want to make sure that that we took care of that for them, so they knew where they could find the info.
Yep, that's a good question. So risk-weighted, I'm gonna quicken the pace here a bit. The risk-weighted in the orange box is what we call our size factor, ticker SIZE. This uses a single measure to weight the securities, and it reweights all 600 names in the MSCI USA index. The measure is the inverse of the variance. What's interesting about that is the input is a risk input. The outcome looks like a size strategy, and the reason is you move the weighted average market cap from 100 billion down to 30 billion. And by doing so, you capture a return series that looks a lot more like a mid-cap index, but you don't have the same level of volatility or risk. So the interesting thing about this is you can get some of that dynamic of investing in mid-caps, but you don't necessarily get the same volatility as measured by standard deviation or beta. So it's been an interesting concept for some investors. And then finally, momentum. Momentum is the most quantitative methodology here, so I'm not going to do it full justice. I'm going to briefly describe it. But the idea of momentum is you want to capture stocks with positive price trends. What you find in the academic literature is whether you look at 3 months, 6 months, 12 months, and you see the winners over the last 3 months, 6 months, or 12 months, they tend to continue to be the winners going forward. So the idea here is that you want to invest in companies that have positive price trends over 6 months and 12 months. And you own a subset of those names. There is a risk adjustment to this, but the methodology basically gives you an outcome where you get 125 securities, all of which have very high positive price momentum. There is some constraints on this. The individual names are capped at 5%. You don't want 10 or 15% in a single name in this methodology. That's not uncommon in some momentum strategies. But the idea is to try to capture those positive price trends. So these next few slides that I'm skipping through show you performance of these ideas. What you'd find is that all of them provide an interesting long-term return anomaly. It'll also show you the exposure to the factor. We do that through the bar risk model. But I want to move on to case studies and client usage. So I'm skipping ahead because I think this is going to be important and relevant to all of you. Before I do that, let me just give you a little perspective on this. Historically, momentum provides the highest annualized excess return, over 200 basis points. It also has the highest risk of these strategies. Quality and size give 160, 170 basis points of annualized excess return. In the VLUE methodology, over its lifetime, has an average annual excess return of about 75 basis points relative. All of those are relative to the MSCI USA index. So they all provide an interesting return anomaly in and of themselves. But when we start to pair them together, they can be equally interesting. So let's talk a little bit about client usage. What I've shown here is a document that came from one of our clients, and it's the specific way they incorporate factors within their portfolio. This looks a little messy in all honesty, but I think as I explain it, it'll come to life and it'll be intuitive for many of you on the line. What you see here in this radar chart or spiderweb chart are three lines. The blue line represents a target portfolio. Think of that as your neutral asset allocation. Right? You've done your work, you've decided you're going to put together certain asset classes, in this case factors, but asset classes could be the way you do it, and you have a neutral portfolio. That's what the exposure at a factor lens would look like in the neutral portfolio of this client. Then, this client does what everybody on this line, myself included, does, is I move from my neutral to my actual portfolio by hiring managers, buying ETFs that represent specific indexes, maybe buying individual stocks, however you get to your actual portfolio. What we know is there's always going to be a difference between what we intend in our neutral portfolio to what we get in our actual portfolio through our implementation. The red line represents my actual portfolio. And what you can see is that there are differences in the exposures I get in my actual portfolio. So this client, what they do is they'll buy the factor ETFs to hedge that risk to try to take their actual portfolio and bring it closer to their neutral portfolio. Then there's a third element here. That element is a target or tactical portfolio. That's represented by a current investment view. Some of you might think it's a great time for a particular idea, you want to overweight that idea, or maybe you think it's a bad time for another idea, you want to underweight that. That's a tactical call based on your investment view. This manager has a tactical overlay that allows them to then either buy more of a particular factor or sell some of a particular factor so that their tactical view is effectively represented. Here's what I'd ask you to take from this. When we think about factor strategies, what this tells me is I can use them both in a strategic portfolio, in this case to hedge risk and the biases of my portfolio, and in a tactical portfolio. The strategic portfolio is often done to try to manage volatility. The tactical portfolio might be designed to try to create alpha or return enhancement. But the beauty is you can use these ideas in both a strategic and a tactical sense.
Mark, with that being said, that you can use them in both a strategic and a tactical sense, we know that the Arizona Pension Fund is a user of these products. Are they better used by an institution in a strategic standpoint, or are they designed to be tactical kind of regardless of the type of investor you are? And is there one type of portfolio that would be a better fit for an institutional investor versus a retail investor?
Yeah, so this chart actually is from the state of Arizona. So this is the way they think about this question. The fact of the matter is, as I talk to pensions, sovereign wealth funds, endowments, or RIAs running money for high net worth clients, I get some of the same questions. So I would suggest that you can use them both in your strategic and tactical portfolio, regardless of whether you're a pension, an individual investor. However, there's one thing you have to have, and you have to have conviction in your investment view. So you'd want to have some methodology to decide when is a good time for a particular factor and when is a bad time for a particular factor. We think that is actually fairly hard to do. Joe Mesrich at Nomura is somebody who's well publicized, who does a lot of work around factor regime. He's I think, perhaps one of the more well-known folks doing that. But for some of you on the line, for individuals, they may not have as much confidence in making those tactical calls, so they'd probably use factors more strategically. To use them, then you have to think about what you have in your existing portfolio. You're not starting from zero. You have a portfolio that has biases. So for people who have a bias toward value, maybe they own, value indexes, they own value managers, things like that, you'd want to think about factors that behave differently than value so that you can pull away from that value risk, if you will, by changing the correlation across your portfolio.
Thank you.
Yep. So that's a good segue. I do want to talk a little bit about, I'll mention these enhanced funds. For people who say, I love the idea of factors strategically, but I get nervous about factor timing, choosing even factors to put in my existing portfolio, the iShares enhanced funds could be a potential answer. They're blended factor strategies. What we find is that blending factors is very powerful because what happens is you can capture an interesting return pattern, but you can reduce the risk because you're combining factors that don't move in tandem, that have correlation benefits. We've done it with quality, value, size, and minimum volatility in this construct. In the interest of fair disclosure, I'm on the investment committee for these funds, so I will say that. But there is an interesting strategic element to having a blended factor approach like you get in enhanced. For individual factors, you see a lot of academic literature on value and momentum. Not surprisingly, if you think about value and momentum just individually, value is about the difference in price versus the fundamental value of the stock. Momentum ignores that and says current winners will be the tomorrow's winners. So they sort of contradict each other in some ways, so you would expect them to have correlation benefits. I'd also say that quality and value, from the work I'm doing, have very interesting correlation benefits. I've looked at the monthly returns of the MSCI Quality Index and the MSCI Value Weighted Index, and what you find is in any 1 month where one of those indexes underperforms the cap weight index, more than 70% of the time the other one outperforms. Now, I'm ignoring magnitude and all of those. I'm just looking at the sign plus or minus, but that's an interesting pattern, and you see that they don't move in tandem, that excess return. And so by doing so, when you pair them, they might provide an interesting pair. Now, I'm not trying to give advice, I'm just suggesting that there are pairings that look interesting when you think about the world from a factor lens versus an asset class lens. So John, I'd like to stop there, pause, and take some more questions if we have them.
Yeah, Mark, absolutely. We have quite a few questions coming in. One of them actually has to do specifically with the momentum index, and there's been a couple questions on how's the turnover in that fund relative to other investment strategies.
Yeah, so momentum has the highest turnover of any of these strategies. I should note that in an index form, all of these have a semi-annual rebalance. So that does change the turnover for a momentum strategy, which is often a monthly rebalance. But the turnover for momentum will be in excess of 100%. So very high turnover relative to these other strategies. The risk-weighted and value-weighted, you'd probably be somewhere between 15 and 25%. So a bit more than another index or a traditional index, but not that high relative to active managers. Quality is a little bit higher than that, but momentum clearly has the highest level of turnover among these strategies.
And does that lead to higher costs for the investor?
So potentially. So there, the fact is there are things that we do to try to minimize the transaction costs to investors. We can do things like crossing. So the scale that we have in our MSCI book of business at BlackRock can help, but it is expensive. We've done some work where we would look at the potential cost drag, if you will, trading in size, and we are looking at maybe probably compliance would have a heart attack if they heard me say what I'm about to say, but it can be a couple of basis points. It's not as high as you might think, but clearly momentum is a turnover strategy. You want to be well aware of that from a T cost and also a tax impact, because I think that's relevant, particularly for those of you managing money for individual investors in taxable accounts.
Okay, and thank you for that. Another one that seems to be coming up quite a bit here, Mark, is if all these factors are included in the MSCI 600 U.S. stocks, then slicing and dicing them into factor-based indices should not add any value. If you equal weight the sub-indices, does it outperform the parent index? So basically, does slicing and dicing really provide any return, and could I just equally weight these and see outperformance over the parent index?
Yeah, so if you equally weight them, you would outperform the parent index. We've looked at a lot of allocation strategies. Equal weight's the simplest one. You could risk weight it. You could do it by trying to maximize your Sharpe ratio. All of those can provide interesting excess returns to the cap index. And I'm happy to, we probably can't go into that in great detail on this call, but I'm happy to talk about that offline in a fair bit of detail. We've done a lot of work on this over the last couple of months in specific consulting engagements with clients.
Thank you. And just for the audience, I want to remind everyone again, if you do have a question, you can submit it in the lower right-hand corner of the Q&A box, as well as the fact that these slides will be available to you within 24 to 48 hours. After the webinar will be emailed to you, and there's also an on-demand section of the IndexUniverse.com website where you can hear a replay of this and see all the slides. So with that, Mark, another question that we're getting here, it's actually looking at size, value, and momentum factors. They seem to be the same as the Pharma French factors based on CRISP data. How does the MSCI data different from that?
Yeah, so you got to start with your universe, first of all. But in the traditional Pharma French value, what I'm looking at typically is book to market. Most of you probably think of price to book. Other value strategies are about price to earnings. You could take the inverse of that and think about earnings yield. That's the common way to capture value. This methodology, in terms of value, is a fundamental index construct. So it is different than Pharma French. Because of that, you get a little different risk profile, and you get different sector weights. So you'll see, I skipped over some of these slides, but you can see in the value strategy, you can see the difference of your sector weights versus, in this case, we just used the MSCI USA, but if I looked at the CRISP weights to a classic value strategy, the Russell 1 value, you would see meaningful differences in your sector weightings. The most notable is often financials. So I think those tell you some of the distinctions between these value methodologies. In terms of size, the size process here is very different. Often when I think about size, what I'm doing is I'm using the log of the market cap. The size factor here is a risk methodology. So you're actually using a risk measure. Your outcome is you get a portfolio that has, effectively you're in that sort of mid-cap range and has a mid-cap return series. The benefit of that methodology, as distinguished from others, is your risk profile, right? So if we look at the risk of the risk-weighted index, or what we call the size factor portfolio, you see very attractive betas, and you see very interesting Sharpe ratios, right? So the return you're getting for the risk you're taking is very favorable for this type of idea and for this methodology, particularly as it relates to the other ways people try to capture the size anomaly.
Okay. And one of the things that we're also seeing come up is certainly was that equal weighted question. We appreciate that, but is actually the environment. Is there a particular economic environment where isolating factors makes more sense, or are they always stand to generate excess returns, or we can expect excess returns regardless of kind of the economic picture?
Yeah, you definitely can't expect them regardless of the economic picture. The fact is that all of these ideas work over time. They may not work in time, and what I mean by that is the environment we're in might favor one factor versus another. And I'm going to speak in very broad generalities, but momentum is a strategy where the market's very strong. You're in a secular sort of bull market. Momentum tends to do really well. So if you looked at periods like the late 90s, momentum did really well. The mid-2000s, prior to the financial crisis, momentum did really well. Quality tends to be a late expansion strategy, or when there's economic uncertainty, people tend to have this flight to quality. That favors quality, that type of regime. So you would see, volatile markets, uncertainty, you'd see quality outperform. Values in early expansion strategy, and part of that is that value often has some leverage with it, and so as you come out of a miserable and uncertain economic environment, you start to see some improvement. You usually get a really strong rally in value. So values sort of early expansion, quality, more late expansion type regimes. We've done a fair bit of work on this as well because it's a hot topic. And, I think it's important to all of us, and it goes back to what's your investment view. What do you think the current environment's going to be? Is it going to be more uncertain? Is it going to be more strongly charging, equity rally type of thing?
So, Mark, I don't want to say market timing, but would you say that there's probably a little bit of art then to using these within an asset allocation?
There can be, and that goes back to that question of, do you want to just get a group of ideas, put it in your strategic portfolio and know that over time they're going to work, or do you want to try to tactically rotate? If you want to tactically rotate, there is art to that. There's various measures you're going to want to look at. They include the strength of the economy, relative earnings, dispersion estimates. You'd want to look at a whole range of variables to try to rotate across these. But some of the sort of the simplistic suggestions I made earlier can be a good starting point, and then you get a little bit more sophisticated. But it's clearly an art to rotate them. It's not easy. That's one of the reasons we did the enhanced products, because within enhanced we have relative stable exposures to these factors, knowing that it's hard to time them, but people want strategic exposure to these ideas, so we blend it in a single portfolio. You can do that through enhanced. You could do it by buying the individual funds and just holding them. The challenge is that if we're honest with ourselves, we have behavioral biases. We make behavioral mistakes. So there will be periods of time where any of these strategies underperform, and those could be extended periods. The question is, will you have the patience to ride it out if you're using them in the strategic portfolio? And only you know the answer to that. There is that art and behavior and science that is relevant to all of this whole topic.
Okay, and we still have time for a few more questions. And one of the questions coming in has to do with, you've mentioned a few times that through these methodologies, you can wind up sometimes with a small value tilt or a small cap and a value tilt to a portfolio. What the audience is actually asking, though, is there anything within the methodology that seems to reduce the exposure to large cap? Or what within the methodology leads to that reduction in the large cap exposure?
Yeah, okay, so let's take a look at the size product. What you see here, this is, I don't have my glasses on. Is that slide 19?
Yes, it is.
It is, yes.
Okay, thank you. So this is the way we think about measuring factor exposures. This is through the Barra risk model. And what it shows you is that in the size methodology, the risk-weighted index, you get this strong negative exposure to bar a size. That tells me that I am playing lower cap names, not big cap names, right? So you see it not only currently, but on average, you're strongly negative to size. So you have a bet against the large cap universe in this strategy. The fact of the matter is, oftentimes when you move away from the cap-weighted index, you do have a size bet that you're making. Commonly, that's a lower size bet that you're making. Sometimes it can be a bigger bet. But if you look at value, what you see here is strong exposure to value. You'd want that. Low, basically zero or negative exposure to size. So you do have a smaller average cap than the index. You're taking a negative size bet. And then you see the other exposures that you would intuitively expect. Low exposure to momentum, for instance, low exposure to growth. You would want to see those things. So the beauty of these slides, and the reason to look at them, is it tells you that these methodologies, in fact, do capture your intended exposure. Value captures value. Risk-weighted captures size. Momentum captures momentum, etc. So the methodologies do provide you the intended exposure. And you can see that they don't provide you some other things that you wouldn't want if you're buying a value or a momentum strategy.
So it comes down to more of understanding what you're purchasing, and if you're going to purchase a value fund, that's what you're getting exposure to, and if you're purchasing a size or momentum, you're going to get those exposures. So it's not just limited to trying to eliminate large cap exposure.
That's right. Yep. What are you getting? When you attempt to do that, what are you getting? So the simplest way people try to eliminate large caps is they buy a small cap or mid cap. When you do that, you inherently take a level of risk. You often are rewarded because you get a higher return. The S&P mid cap has beaten the S&P large cap by a pretty good distance over 1, 3, 5, 10 years, etc. But the beta of that portfolio is 1.2. You may not be comfortable with that. This size methodology gives you a return series that you might like, that sort of mid-cap type return behavior, but with a different risk profile in terms of beta, standard deviation. So you always want to know, am I getting the intended exposure, and what are the other things that come with that intended exposure, the relative risk, the other exposures, the volatility. So I think about risk as beta, volatility, obviously standard deviation, sector concentrations, things like that, because there's always a trade-off when you move to a factor approach.
Absolutely. Mark, so we probably have time for about 2 more questions, and one of them I definitely want to leave you enough time for to close with. But another one that we're getting here is, does staying within the MSCI index family make it easier to keep a tighter control of the overall exposure, or can these products be used in conjunction with some of the other funds that are out there now?
No, they can clearly be used with other products that are out there now. So if you owned an S&P 500 fund, you would still derive some benefit by utilizing a factor strategy that's represented here. So I don't think there's any problem moving away from the single index family because there's generally high correlation across MSCI cap-weighted index to Russell cap-weighted indexes to S&P cap-weighted index, etc.
Okay. And then, Mark, the last question, and this is probably more of a recap of the webinar today, but people are just asking, how do you differentiate factor investing from fundamental investing? I know a lot of people associate Rob Arnott with fundamental investing. How would you differentiate the two if you were looking at them, and give us a little bit of a recap there and close us out with that?
Yeah, so what's common is that we're saying that you can move away from the traditional market cap portfolio. The difference is in the way you move away from it. What I would argue is that the RAFI methodology is a value factor exposure. It's similar to our VLUE value factor fund, right? They're both fundamental indexes. But factors generally are tilts away from the cap portfolio. We want to take that tilt to get a return enhancement or a risk reduction. So we have to believe that you can actually systematically derive a benefit from investing away from the cap portfolio, right? So academics would say, no, the market's perfectly efficient. The only thing to buy is the cap-weighted portfolio. What we're saying is there are well-documented, well-proven anomalies like momentum, like size, like quality, like value that give you benefits to moving away from the cap index. And I think both academically and empirically that's well shown.
Okay, so it really is a matter of what you're looking to go ahead and get exposure to. If you just want pure fundamental, you guys have a product that would provide that. But if you're actually looking to separate these out into different, as they were called, factors, that kind of is where the difference starts from there. Is that you have different exposures that you can isolate within a portfolio.
That's right. Different exposures. You're moving. The fundamental methodology is a value factor strategy. When we move beyond that, we can capture other interesting advantages to quality, to size, to momentum, to min-vol, right? We haven't talked to min-vol, but that's another thing that we could talk about. So I put it in the same broad umbrella, but it's slightly different.
Okay. Well, it looks like we're just at about time. Certainly, Mark, I'd like to thank you for your time. I'd like to thank all those that dialed into the webinar. We certainly do appreciate you taking the time out of your busy day to be a part of this. Again, all the slides will be sent to you in an email within 24 to 48 hours after the webinar. You can also view this webinar on demand if there is anything that you missed and you wanted to catch up on. And certainly I would encourage anybody, if they have any additional questions or concerns, to contact iShares directly. I'm sure Mark and his team would be very happy to jump on a phone call with you and walk you through any questions that you might have. But again, Mark, thank you for your time. We do appreciate it and look forward to having you on in the future.
Thank you.